Discretionary trading is like the Ark of the Covenant. Everyone likes to use the word and describe it with their own interpretation, but very few have a realistic idea of what it really is. Most people think discretionary trading is something in which you don't need to analyze anything and a system or framework to execute, which is not true. I don't care how successful your mechanical system or technical analysis is, eventually your perspective will change after you have done it for years. To understand and really embrace trading, you first have to understand the money paradox. Money paradox suggests that in order to make money, first you have to lose money. This means that no matter what, you are going to lose quite often in this game. In this video, you will learn how a mechanical or technical trader can become a discretionary trader with time and hard work. Initially, I was gonna start with technical analysis and mechanical trading, but then I remembered I have a master's in economics and how stupid and ignorant people sound to me while using probability to define their trading edge. I have been banging my head with data longer than 99.9% of you. Have you ever heard a trader say that his system has a winning certainty of 50%? No. If I replace certainty with probability, then you might say yes. And why do we even think of the chances of something happening and not the chances of it not happening in the first place? Probability is a buzzword in trading spaces and people associate it with the figures of their trading strategies. Probability theory suggests that you can predict the nearest outcome of a set of events, but every event will be independent of the entire set. People take this notion as the most common denominator while bragging about their strategy. For example, they would say they have a winning probability of 60%, but in reality, they cannot produce a 60% win rate consistently for months or a quarter or even a year. This is the reason if you plot your growth, you will see that it is never linear and there will be a lot of false positive events on the curve. Plus, ignoring the outliers in the data because of the biased approach also reduces the chances of the figures being accurate. Why is it so that whenever we want to find a probability of something, it makes us think, let's choose selective data where it's true and ignore where it isn't. Find a correlation between two completely independent things when we analyze data, twist this data according to our narrative or bias, and lie with confidence about the likeliness of it happening. This is why I think applying probability theory to trading strategies is a flawed approach to look at trading. In academia, probability refers to the likeliness of something happening, but in reality, it simply means that I don't know shit, but here are some Latin equations, numbers, and spreadsheets that point to some sort of certainty or an edge if I execute this particular system long enough. Okay, so what about the chance of uncertainty? Because we never try to find the instances of something not happening. I'll keep asking you this question until I answer it myself because this is the most important part of finding an edge. Everybody starts with mechanical trading strategies and all mechanical trading strategies are described in the language of expectancy, which I am not very fond of. Regardless, for the sake of this video, I have to ramble about this mathematical nonsense because until I debunk it, I cannot move to the technical analysis part. The expectancy of a trading system refers to the amount of expected money you will make per trade over a sample of trades. It's great in theory but not practical in the long term. Each term in the expectancy formula is variable over sets or intervals of data. Risk versus reward and win rate are inversely proportional. The more risk to reward you aim for, the lesser your win rate becomes. Most of us are comfortable with a win rate of 40 to 60%. Losing streaks are part of every trading system. No matter what, you can never avoid losing streaks. Not only that, but also you cannot know the consistency of losing streaks. And in addition, the larger the sample size, the greater the losing streak expectancy. The greater the risk to reward, the lesser the win rate, and the higher the expected drawdown because of more losing streaks. Gambler's fallacy is the belief that because in the past I had a win after 5 losses, it will happen again. The problem is that every trade is like a coin flip and independent from past and future trades. Most technical analyses are based on the scoring fallacy in probability theory. For example, after 4 losses, it must be a winner. Or if I had 4 winners in a row, the 5th would also be a winner. Most people think like that, and yet in practice, you never know about the next outcome. Jim Simons is the only rich mathematician in history, and his medallion fund relies heavily on mathematical and statistical models. These models are designed to identify financial market patterns, trends, and anomalies and generate trading signals based on data-driven analysis. But the problem is, his team consists of the best mathematicians in the world. not people with low or average IQ like you and me. The problem with probability theory and its application in trading is all of these things are not inputs of a system or plug and play things. Instead, they are calculated after execution and collecting data. If you want to calculate these things by backtesting historical data, then good luck remembering the famous financial quote. Moreover, it's essentially an information overload, in my opinion, to calculate and get dopamine in advance by imagining this data. It's like calculating a 5% monthly gain, multiplying it by 12 on paper, and then smiling while imagining the thing you will get with that money. It's insanely stupid. Another thing is that all of it matters when you are into multiple trading systems. In addition, no one can manually implement this in their mechanical strategies 100% successfully because you cannot predict markets. But on the brighter side, trading mechanical system is less stressful. However, like I said, it's all good and shiny on paper because win rate, risk to reward, and losing streaks are variables and not constant or even consistent in every interval of data. Therefore, I am not a fan of 100% mechanical trading because what is the point of having a system when you are going to banish it after every 2 to 3 months? Anybody who says that they can stick to a mechanical strategy or make it work long term is either exaggerating or doesn't give credit to his discretion enough. Knowing the past win rate or winning probability of a setup that you trade is your quantitative analysis, but once it becomes part of your implicit memory while subconsciously adding more variables to it and you start executing it like driving a car or playing an instrument or sport, it becomes qualitative analysis. That is where you learn not to enter a trade when your setup appears and yet your implicit memory tells you not to pull the trigger without putting the reason in words. In simple words, a mechanical trader uses quantitative analysis while a discretionary trader uses qualitative analysis. If you are not attached to a certain setup or a probability, your trading decision then depends completely on your intuition paired with risk management. In that case, it becomes easier to control your emotions when things go against you because you are just guessing the market's direction based on your gut feeling. And both your negative and positive exits are based on the objective data of your trading strategy. Before I go any further, I want you to understand how the human brain stores information. It's our basic human instinct to find a reason for anything happening but fail to remember the instances or reason of it not happening. And when we look at the market, we try to find or figure out the reasons for anything happening. It's funny that if 100 people enter a trade, every one of them will have his own reasons for their stop and targets, while they are doing the same thing or have the same conclusion or interpretation of what the market is about to do and bet on it. Most beginners try to find their reasons in indicators and chart patterns and remember those reasons that apparently worked in the past, which is the base of all technical analysis methods. This is how they start modeling their strategies. Only beginners use standalone technical analysis to try to make sense of the markets. But there is a problem. Once the market starts making sense to us after some time, it becomes harder to remember why it didn't initially, because as beginners we don't have enough data to provide us with facts, so we solely rely on technical analysis and we think our technical analysis was right, so this is the reason the market did what it did, ignoring all the instances when the same technical analysis didn't work. I believe every discretionary trader is a technical analyst, but he cannot describe his entry signal in words or with a mechanical strategy. However, he is able to read price charts like a musician, a driver, or a sports player without describing it in words. Technical analysis and mechanical strategies are where all discretionary traders start, but they call themselves discretionary trader as if it's some sort of magic or voices in their heads that tell them what to do. Repeatedly executing trades based on technical analysis or mechanical systems and finding success unknowingly builds intuition and discretion. Every time I listen to someone saying that they entered a trade because of this technical analysis approach or signal after they have spammed their charts with 20 objects and 20 minutes of nonsense explanation, it hurts my head. Price action is fractal, just like anything else in nature, meaning there are an infinite number of geometric patterns that repeat in an unpredictable manner as we zoom in. This also makes markets chaotic, which means there is so much uncertainty that you can never figure out why something particular happens when it happens. Reading price charts charts can be compared to zooming in on the mental broadside. And it's like diving into an abyss of lower and lower time frames to find the information we can understand. We cannot differentiate between a monthly or a minute chart if we are not told which is which. So thinking that one particular shape or pattern on a particular time frame can help you call the market and even bet on it is delusional. Technical analysis is subjective and is like flipping a coin if you don't have objective data about your strategy, your self-reflection in your trading strategy, and the intent or gut shot behind your trading decisions. Instead of relying on probabilities of patterns, consider price action as a language that you can break into different components, each unique and correlated. Everything you learn from the start of your trading strategy, whether it be candlestick patterns, horizontal lines or trend lines, chart patterns perceived from them, indicators and correlation between them, or them all combined to reach a conclusion, is all part of the process of understanding the language of price action. I don't want to get into details of different types of technical analysis approaches because every technical analysis works in certain conditions. But whatever technical analysis technique you are using, understand these things. Our brain sees patterns in randomness while reading price charts, and everybody looks at them from different perspective or biases. So technical analysis is subjective to everybody, derived by their apophenia. Apophenia is seeing patterns that are not there. The variety of apophenia makes the markets chaotic, but our goal is to find non-randomness in these random and chaotic markets. You need to learn to read the candlesticks, how they form, and what sort of price action on lower time frames they produce. Candlesticks are standalone analysis and provide analysis over a period of time and enough information that you don't have to put lines and more objects on your charts to figure out what is going on. If 95% of traders use common chart patterns and 95% fail, then the problem is they are looking and trading the most obvious and easiest patterns taught by trading influencers who don't trade themselves. Patterns always keep changing. No same patterns will work intraday after 3 months. Pattern recognition doesn't work if you think of the patterns in the same length, width, height, time frame, or candlesticks. You need to avoid analysis paralysis and be a quick decision maker. You can do this only by avoiding information overload. Stop complicating your analysis. Stop learning too many markets and strategies. Start with one market and only one simple strategy. Mechanical trading alone doesn't work on its own. Trading decisions always require some sort of discretion or intuition, and it goes both ways. Nobody is a 100% discretionary trader or 100% mechanical trader unless you are a systematic or HFT algo trader. Technical analysis is valid as long as it aligns with the fundamentals, which unfortunately you can't know in advance, which is why you will have to execute to know the outcome every time. Technical analysis is useless if you don't understand how to time your entries, because price charts are two-dimensional charts with time on the x-axis and price movement on the y-axis, and it's dumb not to emphasize on timing on certain things happening on the y-axis while solely relying on the chart patterns. Understand and remember your market's quarterly, monthly, weekly, daily, and sessional market cycles that repeat, and use them. You need to understand the corrective structure that starts emerging 2-3 days ahead of a red calendar day. The numbers on the event don't matter if you are correct in understanding the structure. That fundamental event will prove you right. People are usually correct in guessing the direction but make errors while placing stops and targets because of the flawed technical analysis. The traditional approach is placing a stop above or below the signal structure or target on the next structure. But this is the opposite of what most profitable traders do. Once you understand your subjective technical analysis, trading strategy, and start executing it, you need to analyze your data objectively and identify some important factors that will help you find your trading edge. There is no such thing as risk to reward ratio. It only plays like music in your mind because this horse shit has been repeated in front of you so many times. Tell me why risk to reward ratio matters if one person risks 50 pips for 100 pips but gets his stop hit. and the second person who risked 200 pips for 100 pips and got his take profit hit. Will you still be proud at the end of the day if you have a risk to reward ratio of 1 to 3 but lost money, and yet another person who has a negative risk to reward ratio but made money in front of you? Will you still brag about your high risk to reward ratio? Stop listening to these influencers who don't have a public track record to avoid these silly advices. There is no such thing as a winning probability or risk to reward ratio. Theoretically, both are inversely proportional to each other, but in practice, the result may vary largely because of the application and execution of different trading models in different conditions. 50 years ago, people were happy with their manual cars with no power windows, ABS brakes, airbags, and so on. But now we need automatic transmissions, hybrid engines or EVs, power windows, heated and ventilated seats, lane assist, radar, parking sensors, auto driving features, and God knows what else. Trust me, these things don't make you a good driver. They only overload you with information. Understanding your maximum adverse excursion helps you to place a stop loss, and your maximum favored excursion helps you place a take profit. You can find your strategies MAE and MFE by analyzing past trades. If you can figure out the average MAE of your winning trades and the drawdown of what your trade goes into before turning into profit, you can set that as your standard stop. The same goes for MFE. By taking the average of how far your winning trades go, you can set a standard take profit in your strategy. Now remember, both these MAE and MFE are also variables, not constants. So they will be changing according to the market conditions. People also find ATR useful for figuring out things, but I don't. I use my own MAE and MFE plus my intuition. Plus I get out of trades manually when I sense something is wrong, and it has worked for me most of the times. Whatever your physical stop is, always have a mental stop. You also need to analyze the time it takes for your trades to become profitable. There is no such thing as perfect, but find the best possible instrument, time frame, conditions, time, and direction that you can make sense of, and never deviate from these set parameters, even if it means some losses along the way, because it's better to lose while executing your trading strategy than to win a trade outside your trade plan and strategy, because it will create a bad habit without you realizing it if you keep executing trades out of your trade plan. Trading strategy and trading edge are two different things. Your trading strategy covers the framework of your entry and exits, or in simple words, the mechanical aspects of how you will execute. But your trading edge is something when your strategy shines. It could be a certain market condition, or maybe something only you understand and can execute. From my experience, only 2 to 3 out of 100 trades qualify to be based on your trading edge. You have higher chances of winning, and in addition, much more reward than risk. But you should always remember that a trading edge is 100% discretionary or intuition based. I don't use pending orders to enter trades for two reasons. Leaving a pending buy or sell order to enter a trade somewhere means you know what the market is going to do instead of following its lead. Basically, you are not relying on the intuition. Instead, you are trying to impose your thinking on the market that it should do this or that. Entering trades with pending orders means you are trying to predict the market or know what exactly it will do. If I make sense of the market during my screen time, I open a trade with a market order and babysit it based on my plan for few hours. But at the same time, I have proper rules for auto exits and manual exits. I think set and forget trading doesn't work when you are a discretionary trader. Unless you feel proud of taking full losses, ignoring the bad feeling about the trade, and yet closing it at break even after seeing your trade go in 2 hours or 3 hours and reversing, but keeping it open because you relied on the mechanical aspect or market structure. The thing is, everybody has a different edge, so everybody can describe their experience with set and forget differently. As far as my trading strategy works, I cannot describe my entry signal candlestick pattern or something, but if my first instinct is to trade, I enter a trade. Otherwise, I don't. If after the night, market gaps against my trade direction on the next day open, I close my trade manually. Sometimes I get this vibe that makes me get out of the trade manually, even when price action seems okay, and it has worked 99% of the time for me. As a rule, if my trade doesn't go immediately in profit and keeps going in negative, I close it with half or less than half loss. I can also try again for an entry if I had opened a position earlier but closed it because because it felt like I entered early, and many times it helps me to adjust my position better and to catch more pips. Trading psychology is propaganda and a false narrative pushed by trading influencers. They keep talking about the psychological aspect of trading as if it's the only thing that matters. Why the psychological problems matter in your fourth month of trading when you haven't even figured out your strategy yet? Suppose you are executing without any error and yet you keep losing. In that case, it either means that your trading strategy is shit as a whole, or you are making errors while timing and choosing exits, which is due to the fact that you don't know the objective data of your strategy because you haven't executed it long enough, or you did execute it for months but didn't collect or look at the objective data. Stop convincing yourself that your trading strategy works and it's the psychology part you need to work on now. The reality is your trading psychology is shit and your mental health is ruined because you refuse to admit that your trading strategy is shit in the first place, and you keep banging your head against the brick wall hoping for a different result every time, blaming your psychology and a multitude of other factors for your failure. Stop listening to these motivational speakers or trading influencers who try to convince you that you can break through a brick wall with bare hands just because you persevere or want it bad enough. First, test different strategies and find the one that works for you. Everything from simple indicators to complicated works under certain conditions once you have executed it long enough. If you have been going in circles for 3-4 years around a particular trading style, whether it be scalping, day trading, swing trading or whatever, you will figure out everything automatically. In addition, your brain will rewire itself along the way to execute it like a muscle reflex. Just give yourself enough time to let your trading style become part of your personality. If you are risking more than you can bear and start making execution errors because of it, it's not a psychological problem. It's a risk management problem. If you are opening and closing trades in loss out of your trading plan or strategy, it's not a psychological problem. It's just that you don't know what the are you doing. Stop this BS, please. Yeah, trading influencers, I'm addressing you. Stop calling everything a psychological problem. Besides, psychology is a pseudoscience, not a real science, because 99% of the research or studies around psychology academia cannot be replicated. Most of the studies are funded by the pharma industry to gain profit. It's like, let's invent a new disorder for which we can train more and more therapists to listen to these Gen Z crybabies and women with zero self-accountability and also profit from prescribing RX drugs. Human behaviors have infinite fractals and you can never generalize or universally apply the same fancy psychology term to everyone. If you are a psychologist, it's quite possible that you will not be able to trade. But if you are stubborn enough to trade long enough, you will automatically become a psychologist because it's about knowing yourself rather than knowing about the markets. And you learn to predict human behaviors along the way. The problem is that you are going too fast or trying to do it as soon as possible without ignoring what's part of the process. All these things, testing different strategies, failing, realization of markets on a deeper level, or the simplest and stupidest technique that works for you are part of the process. The most important component of this process is building implicit memory of the markets, self-accountability and self-awareness for being able to or not being able to do certain things. Our brain remembers things based on the information or variations of the information we consume about those things. For example, when a person's name is mentioned, we instantly remember their voice, appearance, and anything else we know about them. Our brain stores information about everything in this way, whether it's an object or a person. If you know multiple people with the same name, you differentiate them by their surnames, their appearances, or what other information you have. When you see the same make and model of a car with different colors or specifications, you recognize it as a variation of that particular car, and it works almost the same way for everything else. The more information we consume about anything or interact with it, the more clues it leaves in our instant memory, which transforms into our intuition or implicit memory over time. Implicit memory saves this information and reuses it as a muscle memory. For example, while driving, you unintentionally look at the right rear view mirror when turning right, and vice versa. When a person's name is spoken in front of you, you instantly remember their appearance, voice, how they move, and so on. Or how a musician plays an instrument or an athlete plays a sport. It's all implicit memory, and you can build this implicit memory only by interacting with that that thing or the person. At some point, we start understanding a person's next move when they say or do anything because we have so much information about that person that we start understanding his psychology. Essentially, this is what exactly you do when you are a trader. You basically understand the market's psychology by judging its movements and you know how to react to it, which is trade execution. The market is a hive of hundreds of thousands of traders and their combined narrative or sentiment about that particular market. Whatever you learn in trading is basically the information that you gather and store in your memory. You start from candlestick patterns, chart patterns, indicators or certain setups, and when you follow or interact with those things consistently in markets for long enough, you discover how the market reacts to them, basically understanding the market psychology. Unknowingly, you start combining certain setups, their timings or occurrence, and market's reaction to those setups to build intuition, as if you are solving a puzzle by putting its pieces together. If you execute those subconscious signals, their accuracy is insane. Does that mean you will be right 100% times? Never. Maybe you will lose more than what you make, but that's not the point. The point is to learn trading as a skill. Some people who are or have become self-aware and self-accountable may take a few years to see any consistent growth. And trust me when I say this, anyone who is not okay with being self-accountable is unfit for trading. Any sort of destructive behavior will haunt you, so either you will have to change your destructive behavior or you will just quit trading. And there is no other way around it. The problem that haunts most traders for years is not being self-aware or even being self-aware but not being self-accountable. It's like knowing that you are going to do a stupid thing which ended up badly last time and yet doing it anyways. For example, if you know from your history that you should stay away from the market on Wednesday because it has often ended up in a loss, yet you find an opportunity based on your technical analysis or whatever and trade it. It's because you trust your analysis or flip of a coin more than your objective data. So it's better to be self-aware about your trading habits and be self-accountable about them, because at the end of the day, there is no one else who you could blame for your trading failures. If you have been trading long enough, you might remember that in many trades, your qualitative analysis says that the market has gone 1 hour in your profit, but now it is about to reverse by looking at the chart and yet not being able to figure out why. But your mechanical strategy or quantitative analysis makes you think that this is the right setup, it has this much winning probability with this much risk to reward ratio, and it will be alright. Finding out later that your subconscious or qualitative analysis was right and you got closed on break even or in a loss if you didn't move the stop. Or sometimes you have a planned trade and you see your signal, but your heart tells you something is wrong and not to take the trade, yet you choose to believe your mechanical setup or quantitative analysis and execute it, only to find out later that your subconscious was right in warning you not to take this trade, and so on. All those things are because of the cognitive dissonance between your mechanical strategy and your implicit memory plus gut feelings. Therefore, in discretionary trading, your gut feeling is your best ally. You have to admit, anybody who has achieved something that others couldn't had some sort of self-belief. I think self-belief plays a big role in discretionary trading, because how else would I decide to execute if there is no mechanical advantage or signal on the charts? You build self-belief by execution and not by backtesting on historical data. The reason is that you already have seen the data and now you are literally replaying it. It's like watching a walkthrough of a game on YouTube and then playing it. Trading on market replay never makes sense to me. It goes back to a lot of reasons, but most importantly, like I said earlier, market patterns keep changing. So if you think you can get the same results in present markets by backtesting 5-year-old data, good luck. Unless you are someone with resources plus a background in mathematics academia and have friends who could help you figure out something like Jim Simons. But unfortunately, there is only one Jim Simons, rest in peace. Or unless you are a position trader, which again is a big boys game, we as retail traders don't have the patience or side income to wait for months to catch or execute a trade. Self-belief comes from self-awareness, which is achieved by competing against yourself and avoiding cognitive dissonance while making decisions under pressure. You have to execute your system whenever you get a signal. This is because you can't predict the outcome of the next trade, but you can predict the near outcome of a set of trades. And that is only possible by believing in your edge to work in the long term. It took me 5+ years to see any significant growth and a winning streak that lasted for less than a year, then a brief break-even and drawdown period that lasted until the end of 2023. 3. Now I am again in the 6th month of a winning streak and 3rd month here on YouTube officially. I mentioned this in my first video that I had a belief that one day I'd figure this out, and I eventually did figure it out. And I think I stumbled upon something that is working for me now in every market condition. I understand that it will never keep working, but as long as I am self-aware and self-accountable and keep refining my trading as a skill instead of relying on a particular mechanical system, it will be fine. Cognitive dissonance can be described as the discomfort you feel while making decisions because of two contradictory and opposite beliefs fighting each other in your brain. Cognitive dissonance is the second biggest reason for execution errors. Well, from my personal experience, I face cognitive dissonance for only two reasons. One, I have no idea what I am doing while trying to impose a trade just because it felt good when I saw the setup first. There is a fair chance that the price will move against me and I will soon realize that I was in a hurry or completely wrong. But I let that hit my stop out of my ego that actually made me enter the trade in the first place. 2. I have a clear idea of what I am doing. I have a clear setup. Timing is perfect. But right after I enter the trade, I get a sudden distraction like a phone call, a knock on the door, a text that I don't want to respond, or call for something that I don't want to do right now. That distracts me. I start breaking my rule. I'll close the trade in loss, enter again, close it again in the loss until I am overwhelmed and leave the trading desk in frustration. And you know what happens next? Yeah, I was right all along, but that distraction cost me losses when my trading idea, entry, and everything turned out well. My physical health or personal life stress also plays a big part in cognitive dissonance in my trading. You can see this throughout my trading history. Most of the money I give back to the market is because of this reason. Now, how do I deal with these things? For the first, I don't impose trades anymore. I used to, but I have taken only 5 trades so far in this quarter that I consider were imposed trades. On second thought, my job as a trader is to execute when I have a signal and not think about the outcome of that particular trade, because losing streaks don't bother me anymore. Sometimes if I initially think the setup is good because of an analytical error and I enter a trade, I have set a rule to help me figure out during the first hour of the trade if I am correct or wrong and get out as soon as the market goes to my mental stop. For the second reason, I did not just choose the hours right before the daily close because they provided me some sort of advantage. I choose this time because my screen time window starts at 11 p.m. in my time zone, which means most of my family is asleep. I am not to expect a knock on the door, no expected call or text or any such external factor. Even then, if I have something going on that I think will make my judgment flawed, I am not going to enter trades that day. After all this, I get a call or text every now and then because the sleeping schedule of my son has changed, and if he is awake at night, it will probably be a nightmare for me and will be reflected in my trading history. But I cannot complain or cry about it. It's part of my life and I have accepted it as a false positive on my equity curve. You know, a man's gotta do what a man's gotta do. Eventually, I'll solve this problem too. I always do. Cognitive distortion is referred to bias thinking. In trading, it's overgeneralizing the market price action or pattern. It happens because of not having enough understanding or a clear idea of how you trade, jumping to conclusions, or interpreting a trade negatively without actually entering. Getting proven wrong multiple times or losing streaks at some point makes you think it's not just a losing streak, rather you can't get any worse and you should just quit trading. There is no other way except to embrace losing streaks and focus on execution. All or nothing. Viewing trading setups in the extreme, such as anything less than an A+ is a failure. It's because you are a mechanical trader and you don't give discretion any credit in your trading. Having a mechanical approach to your setups is good, but you gotta have that element of intuition or discretion to trust your system. It's more important to know why something didn't work than the reason why it worked. People keep finding things that work while ignoring the fact that they already know what doesn't work. If they analyze what's not working and do only the opposite of what's not working, they will succeed. Personally, I don't have any written rules to describe when things work, but I have written rules when things don't work and when to close a trade or sit away from the market. The problem among beginners or struggling traders is that you consume so much information that instead of helping you in trading decisions, it starts confusing confusing you. When I say not everybody can execute every strategy, it's because everybody has a different type of mind that will see and like or filter certain patterns or things and help create more sense of self-awareness about them instead of any other thing or pattern. And that is where your edge lies. It could be a certain setup on a certain instrument on a certain time frame at a certain time of the day, or how else you define your entry signals. You may ignore those certain patterns of things while following a herd on the internet that is narrating a popular strategy, and you think that you will make money only if you follow that particular popular strategy instead of being self-aware and following your own mind and preferences. This comes from the same idea that every human likes different colors, shapes, smells, which means as an individual, their mind has its own preferences. People like to brag about their preferences when it comes to real life, but ignore these things when it comes to trading. It's because they don't know how to filter the useful information from all the noise or useless information. This is one of the reasons I don't follow anybody on the internet who posts anything about their trading strategy, analysis, or their trades. If somehow a post appears in front of me, I instantly click not interested so that the algorithm knows that it doesn't have to show me such posts anymore, because I am not interested in their setups or strategy, and I am only interested in my own trading strategy and my setups. This helps me not only filter the unnecessary noise but also completely focus on my own thing. Another reason is people like to brag about 100 setups, instruments, and trading styles at the same time, or having a self-ego to consider themselves good traders only if they trade many instruments, styles, and things simultaneously. Although this is a popular narrative, but trust me, that is where you need to be self-aware and self-accountable and listen to the deep voice in your head telling you that it is only like this particular thing or this is what is going to happen. Sometimes your senses might be telling you that the market is about to do a certain thing, but your shiny ego, complicated analysis, or the influence of a social media influencer who posted a chart of that particular instrument earlier predicting something that goes against your senses, or there is a red calendar day coming, and because your favorite trading influencer told you to stay away from the market on red calendar days, or all such factors somehow convince you not to pull the trigger, only to see the market do exactly what your subconscious signals told you and then scold yourself. You have to let go all your ego if you want to become profitable in trading. If you can pop this ego bubble of yours, you can successfully close losers quickly, hold winners for longer, be self-accountable, stop being arrogant, and start becoming humble. The last thing is that you need to lower and, if possible, eliminate expectations from your individual trades. Learn to expect the outcome of 30 or 100 or 1000 trades instead of any individual trade. I think anything less than 25 to 30 trades is insufficient to figure out objective aspects that you will use to execute your trade. Finding a verbal reason for your entry is against building intuition. Another important reason is that you think you can understand what you are doing and define or represent them as some patterns. The problem is, if you try to break down your intuition or discretionary edge into certain patterns, it will create cognitive dissonance and you will get confused a lot of times, leaving many trades just because you couldn't pull the trigger as your technical pattern didn't appear. However, you understand the market structure, but as it wasn't like the patterns you specified for your entry, you missed the trade. In the start, I tried to include some specific patterns in my strategy, but it didn't work for long and I faced cognitive dissonance. Now I don't have any patterns saved somewhere in my notes that I look or check before entering trades. Only mechanical trading systems are based on set rules or parameters. Basically, mechanical trading is aimed at solving the same problems that appeared in the past, while discretionary trading is never about set rules, maybe some risk management rules, but trading decisions are not based on set rules and deal with and solve new problems in real time. Decisions in discretionary trading are based on very rough frameworks. I am a discretionary trader, therefore I have a very rough framework that is constantly updating and based on adaptability to the current market condition. The point is that you will never be able to build intuition in trading if you keep trying to find a verbal reason. If I am wrong, please help me find a discretionary trader who can verbally describe describe his trade signals. Of course, if he is a content creator or sells a course, he will post or sell a copy-pasted verbal description just to justify his trading to his audience or future customers. I think price action is a sign language or body language in which the market communicates, and anybody who can learn the language of price action can learn to trade. When you become a discretionary trader, you can imagine your market as a person. You understand its movements and reactions to certain situations, like you understand a person's personality or psychology. In simple words, you start understanding the market psychology and what happens if it shows you this sign or that sign. Does it mean you may call the market every time? No, but you will find something that can make money in long term. Once you master yourself, you may use only your subconscious signals or discretion to execute trades, like playing a musical instrument or playing a sport. After you have practiced your subconscious signals enough, the transition happens. Now you are not a mechanical or technical analysis trader, you are a discretionary trader. Remember, it could take many years before you achieve this level, but it happens in every trader's journey if they don't quit early. Understanding market psychology also means finding a point to buy or sell, after which the majority is supposed to keep doing the same. It's basically predicting or guessing other market players' behaviors. Trading in its essence is all about predicting the behavior patterns of the portion of the human population involved in financial trading. As trading is all about making decisions under pressure, you can apply game theory to trading. Traders basically rely on each other to either facilitate each other's trades or get on one side to push the price in each other's favor. Game theory basically uses people's personal interests against them. In simple words, if I am buying something, I am relying on the expectation that someone will sell it to me, and after that more people will keep buying, and where I think the other players will take profit, I will take profit. And yet none of us is proven right or wrong until only afterwards. So there is undoubtedly an element of narcissism and selfishness paired with competency tied to trading decisions. In simple words, the game theory helps you to understand or predict market behavior or the behavior of other traders. Does it alone help you to succeed in trading? Certainly not, but it can help you understand markets from a broader perspective in the long term. Then it only becomes a guessing game where you are guessing market behavior and betting on it. Simple as that. Another important factor in developing a trading edge is the personalization of your trading strategy. Unless it's a data-driven or algo strategy, personalization of trading strategy plays a very important role in building intuition. Learning to trade is not like preparing for a psychology exam, and you don't need to take an online personality test to find what personality type you are. You build your trading psychology and personalize your trading strategy along the way. It's because trading will exploit and test all your emotional flaws. Now, if you are self-aware and self-accountable, you will solve the problems and set rules instead of going to a therapist and spending an hour ranting about how the market is against you and blaming other factors for trading failures. It's because how you do one thing is how you do everything. Your nature always reflects itself in all the other aspects of your life. Whether you are hasty or patient, quick decision maker or over-analyzer, good with money management or not, afraid of certain things or not, and so on, you will discover all your personality traits while trading. Personalization of your strategy will also include your most favorable market, time frame, direction, time or day of the week, entry technique, and so on. You will find all these things by analyzing your data objectively. The point is, stop copying other strategies and find your own edge that aligns with your personality, because that is the only way to survive in trading in long term. No matter what your trading strategy is, it's not complete without a general knowledge of economics and geopolitics. Just the general knowledge, not the analysis paralysis or listening to long form videos of trading influencers speaking nonsense about certain fundamental events, their expected numbers, and their expected impacts on certain instruments. Let me simplify how I see fundamentals and geopolitics and include them in my strategy. I look at these fundamental events to find trading opportunities, but completely differently from you. In my experience, fundamental events create impulses in the market. That impulse could be in a lower time frame in the direction of the existing trend, or a correction in a higher time frame opposite to the existing trend. Now, I am saying it without needing to know the actual numbers of those events. I don't want to know the numbers. I want to see the market's reaction to that event and whether it's favorable for my entry. In my experience, most of the fear of losing the next trade comes from the fact that you use a size way bigger than you should be. It could be because you want to pass the prop firm challenge on the next trade, or you consider this setup the best according to your strategy, or what else. But the problem is, the next trade outcome is always uncertain. You can never predict the outcome of your next trade. Therefore, you will never see me categorizing my setups or use different risks on different trades. Plus, I am never comfortable in using a lot size that I cannot use for 5 consecutive losses. If you are focused on your P&L box more than your setup or price charts, lots, then it means you are risking more than you should be. So lower your size and test your edge. The first priority of a trader is not to find a good trade. It's to manage risk to survive long enough to find a good profitable trade. It also might be because you are on a losing streak. The problem with losing streak is the bigger the sample size, the bigger the losing streak may become. So even if you have a 99% win rate, theoretically you can have 3 losses in a row if you execute 1000 trades. And that is when you have executed your strategy like a robot with fixed parameters, which nobody can. Also, this 3 losing streak in 99% win rate from a data of 1000 trades is not accurate because it's based on mathematical expectancy and only good on paper. In fact, you may get more than 3 losses in a row. And to be honest, practically we may never know how long the losing streak may last, but we can tackle it by lowering size to half after 3 to 4 losses in a row and start getting immune from fear of losing, and gradually improve and include more precautionary measures. Like I said, trading is a skill and skills are learned through failures. So your first priority should never be about winning the next trade. Instead, you should focus on how to decrease your loss if the next trade is a loser. I always enter a trade with the worst case scenario in my mind. This may be because I have a win rate between 30 to 40% and I am prepared for a loss anytime. I have always played games initially on PC and then mobile games as far as I can remember. And I can say this confidently that if you have been a gaming addict, especially in PvP games, and started trading, you have an edge over others who are not, as gaming helps you become a better problem solver and be consistent in putting in efforts. It's because gamers take the most realistic approach to bypass the fear of losing after losing multiple times. It helps you pass all the mental hurdles if you are only focused on the next trade. Like in gaming, you are only interested in the next game. Another thing is, games from beginning help you to learn to build muscle memory and improve quick decision making skill. Trading, just like games, is easy to play but difficult to master. But have you ever noticed how long it took us to master a game? Or when you played a game, were you focused on playing the game, mastering moves, enjoying it? Or were you focused on increasing your level, gaining more experience points, or whatever measure the game had to show you your progress? If you apply this analogy to trading, then most of the problems in trading come from focusing on the profit and loss figures and not from the analysis. Many times we trust the market structure and yet we fail to enter or close a trade earlier because we don't want to lose the experience points or money in this case. So what's the solution? Well, from now on, try hiding your P&L box and only trade the chart and take your trading decisions solely by looking at your chart and not the dollar amount of your trades. Your brain will resist in the start and you will have this constant urge to check your P&L box, but trust me, if you do this for at least 3 months or 30 trades using only one particular strategy on one particular instrument, all your fears of losing money in trading will go away and you will start understanding the language of price action like you can understand sign language or body language. Another thing is that gaming helps you learn to predict human behaviors in real time, especially if you play PvP games. By predicting another player's next move, you can take a decision to counter that in real time. You can use the same analogy in trading as you can make trading decisions by predicting what the other market players think, taking their side or betting against them. If you can handle the mental hurdles and focus on execution more than any other thing, your brain starts storing information about markets in your subconscious. And that is when your setup, which was previously a mechanical setup, becomes part of your muscle memory and you execute it at your discretion, eliminating all other factors. And that is where you transition from mechanical trading to discretionary trading, because now you don't need a reason. You just execute trades without relying on reasons. By reasons, I mean trying to put your perspective in the form of some lines or shapes and not the framework of your strategy. It's just like calculating some numbers in your mind without using calculator. Or let me give you another example. What if you know a little bit English but you start watching an English movie without subtitles and try to understand the conversation as a whole instead of relying or knowing the meaning of each word? That is exactly how I learned English initially, as my native language is Urdu and its variations. Mechanical traders draw lines and shapes on their charts to justify their reasons, while discretionary traders don't. That is the only difference. People on the internet build you versus us narratives and become extremists in everything. Saying proudly that you are a discretionary trader always has an element of arrogance and pride in it. You think that you are better than mechanical traders, and same goes for mechanical traders. At this point, I know some trading influencers who have 100% mechanical systems and yet they like to call themselves discretionary traders. Why? Because discretionary traders are considered better? I mean, come on yourself. And I also know people who lie on the internet for the sake of content creation, describing their setups or trades mechanically. And they need this explanation so that it may create an idea in the viewer's mind that the guy knows what he's talking about. So let's learn from him and at least give him the watch time, if not buying the course or joining his community. People completely ignore that part of technical or mechanical trading which became part of their implicit memory and turned into discretion. But once they become discretionary traders, they completely negate that they have any element of technical analysis approach to their trading decisions, which I don't agree with. I can proudly call myself a discretionary trader, but I also don't think that there is anything wrong with admitting that there are certain technical rules or things that I look at while executing trades. Mechanical trading is basically plug and play and doesn't require much emotional endurance in the short term, but discretionary trading depends on emotional competency. Mechanical trading is not a skill, it's based on the probability theory, which is not a real mathematics. It's a pseudoscience created by modern marketers. Anybody who wants to sell you something will associate his thing on percentages and probabilities. While discretionary trading is a skill that you learn and make it part of your muscle memory with discipline. Discretionary trading requires adaptability consistently. You cannot rely on a particular thing to work for the long term. It's very stressful in the start, but once you start doing it consistently, it becomes a skill like no other. Discretionary trading requires emotional maturity. You cannot bash or fight yourself or the markets if you lose. Mechanical trading is based on set rules, which means you tend to solve the same kind of problem until the market conditions change and you have to create new mechanical rules. On the other hand, discretionary trading requires critical thinking skills, which means you always have to challenge yourself to solve a new problem every time. Mechanical trading is boring, but discretionary trading is full of thrills, excitement, and all sorts of emotions that make us human beings. People on social media tell you to become emotionless robot in order to become good traders. I differ from that advice because why do you have to remove that particular element from yourself to trade when that element is the difference that provides us an edge over all other living species? The market is a collective consciousness and I don't believe we need to remove our own consciousness to trade it. Stop fighting your emotions and use them in your trading. In mechanical trading, you cannot take advantage of huge moves and full power of your brain because you rely on set rules or algorithms. Therefore, if you choose mechanical trading, I think if you have a mechanical system that works, create an algo for it, plug and play, make money with it as long as you can, and meanwhile look for new systems and test them and create algo for them and repeat. On the other hand, discretionary trading allows you to catch bigger moves and constantly improve and refine your trading skills. But even then, you need to control your greed. You cannot hit home runs on every trade. Develop a sophisticated target system that evolves and adapts to market conditions. Mechanical trading is based on robotic behavior, or should I say on taking orders. However, discretionary trading is based on sign language communication and the consciousness of the markets and yourself. Mechanical trading is based on trusting the system of set rules and finding certainty in the markets, while discretionary trading is a completely different beast. It's about trusting your gut and dealing with uncertainties by adapting and solving a problem in real time with the help of your consciousness. Mechanical trading strategies can be backtested, but discretionary trading systems cannot. You build discretion with forward testing only. The fulfillment you get from discretionary trading is huge as compared to mechanical trading because you are using your brain power, and every time the market proves you right, your trust level on your system one-ups. On the other hand, in mechanical trading, we are always trying to find and test new systems because we know that our mechanical system will stop working in the near future. This is why you always hear people using the word my systems or my strategies and not my system or my strategy. People don't even want to execute a system for longer because of the lack of confidence in their own skill. The notion keeping your losses small and wins bigger doesn't mean what is narrated on the social media, and keeping your losses small has nothing to do with risk to reward ratio. In mechanical trading, this approach of keeping losses smaller by having a high risk to reward ratio may be correct, but in discretionary trading, it's purely based on gut instinct and objective rules of your system. For example, after seeing your setup and entering trade, if you feel it's not going anywhere or something is wrong, you close the trade with a small loss and observe that you made the right decision. In addition, you may extend your take profit based on your gut feeling that the market will go further and catch more profit, which is not possible in mechanical trading because most mechanical systems are set and forget. And the last point, as a disclaimer, being discretionary traders, you are always relying on your gut instincts and dealing with your emotional triggers and reactions to the outcomes of your trades. You will feel surge in adrenaline adrenaline and dopamine levels while winning trades, but your emotions and gut will also backfire when you get a losing streak. Lose a challenge, blow a funded account, not being able to execute in time, you will get constipation, nausea, diarrhea, insomnia, or however your gut responds to negative stress triggers. It's because you are using your emotional endurance constantly. Some of you will become patients with high blood pressure or some sort of mental disorder. Personally, I get constipation if I am on a long losing streak and I don't take break from the trading. So it's very important to take breaks every now and then. Only mechanical traders can teach because they have set rules and they have no consciousness involved. So when their system fails, they start doubting not only their systems but also their psychology. And that is what they narrate on social media. They don't even give their own system enough time to know whether it's a systematic problem or a psychological problem. Discretionary trading is all about the alignment of your consciousness and the market's consciousness. It doesn't mean that you can pinpoint every move in the market and make millions. You will be proven wrong many times and have losing streaks, but even then you won't start second guessing your strategy or your psychology because you will know exactly what's wrong with your objective data, whether it is your strategy or your way of understanding market behavior. And that is also why you will not only overcome or ignore losses easily but also keep them as small as possible. Here is my strategy. I am risking almost 10% of the account on every trade. If I let every trade hit my stop, I'll blow it quickly. On the other hand, I quickly adapt to market conditions and change my mental stop, which is proven right most of the times. A discretionary trading system is created by and for an individual. It's all about data and its relevance to the subjective goals of that individual. That is what I have. I designed a strategy based on my experience, intuition, and data. And this is what you will do eventually, unless you hit rock bottom while testing and executing different mechanical systems and keep hopping from one system to another and one market to another. I can guarantee it, if you execute one mechanical system on one pair consistently for 1 to 2 years and keep refining it, it will be converted into a discretionary trading system. But again, one system and one market at a time. I never recommend anyone to start discretionary trading directly because you will melt down very quickly. Instead, start with a mechanical system on one market and keep executing until it becomes your muscle memory, and then you can transition from mechanical to discretionary trading by keeping the strategy mechanical but with objective rules in place. The idea that feeling sad or anxious in trading is a psychological problem is wrong and a lie. It's because if you do anything difficult like playing an extreme sport, falling in love, or making through the hard times in your life, you are going to feel psychological discomfort, and it's part of our nature. And again, trading is very hard, so it's completely normal to feel those emotions. But it's also very important to learn to use or overcome that discomfort or emotions to anticipate market moves and enter and exit based on them. I'll wrap up this video with a harsh reality, which is nobody can succeed in this game unless they have their back against the wall. Meaning there is no plan B other than trading, and you cannot succeed in trading unless you make it part of your identity and refuse to quit. Trading for a hobby is difficult and trading for a living is even harder, and this is why people pivot towards content creation or selling services in trading industry instead of just relying on the trading income.